Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Welcome to Bloomberg Markets. I'm Vonnie Quinn with Tim Stenovec on this Friday, July 5th, post-Nonfarm payrolls. And of course, a lot to talk about. It's not just post-jobs data today, Tim.
Yeah, we thought it was going to be kind of a quiet week, right? But not really. We have big UK election results. We're going to talk about that. Biden holding a campaign rally a little bit later. We'll bring that to you live as we do get it. And of course, those payroll numbers, Vonnie.
Exactly. And markets that are on the move. And next week, we already get into earnings season and we have Fed Chair Powell speaking. So we really are ramping up the activity here, and it is interesting to see stocks on the move with the Nasdaq 100 now up 0.9%. But just to repeat those numbers in case somehow you might have missed them today, we had June non-farm payrolls up 206,000, but some revisions downward to some previous months. The unemployment rate at 4.1%, but not triggering the SAM rule. Let's get to somebody who knows a lot more about the inner workings of the non-farm payrolls report and how it's impacting bond markets and yields. Michael McKee joins us now in studio. And Michael, the revisions were very important. Are they typically this important to the bond market?
Not typically, but basically this is one of the largest sets of revisions. They go back and revise the prior 2 months that we have seen, and 111,000 jobs taken away is quite a bit. So basically it sort of evens out the number we got today to the last 2 months and suggests that the economy and the labor market are still relatively strong, but not as strong as the Fed might have thought.
And I'm guessing my question, though, Mike, is really about when things go from bad news being good news to bad news actually being bad news, because the labor market weakening is good news for the Fed. I mean, this was a Fed-friendly report. Look at the bond market, no question. But at what point do they start to see too much softness in the jobs market?
That's a good question. They predicted 4.1%, which is what we have, by the end of the year. Now, does it stay at 4.1% or does it continue to worsen? That's going to be the big question. Does the SAM rule come into play? Does the SAM rule even apply in the current macroeconomic situation? We
should ask Claudia Sahm about that a little later. She's going to be joining us.
Call her up, see if she'll... because the other half of this is that wages are still rising, 3.9% year-over-year basis. Even if you're looking at the CPI instead of the Fed's PCE, workers are still getting ahead in terms of pay over inflation. So there's good news and there's bad news.
So they are still getting ahead, Michael, but at least that didn't tick up, right? 3.9%, year-over-year, 0.3% month over month. Is that enough to calm the Fed that, inflation won't be ticking up, at least thanks to wages?
Well, we're not there yet. The Fed looks at maybe 3 to 3.5%, closer to 3, as a stable level of wage gains. It's the level you would want to see if you had 2% inflation, which is their target. So they're still thinking that's a little bit high. But the progress in coming down, especially with the labor market cooling, and a lot of the labor market cooling we saw today was in the services sector, which has bothered the Fed because that their primary input price is wages. So if we're seeing wages come down a little bit and fewer jobs, it's going to take some of the wage pressure off going forward.
Okay, the June payrolls report is behind us. Let's move to next week when we hear from Jay Powell. He's going to do his semi-annual monetary policy report to the Senate and the House, and then we get June consumer prices out on Thursday.
Yeah,
it's quite a week.
It's going to be quite a week. I think the CPI is going to be more of the focus. Jay Powell is probably not going to give an indication of where the Fed's going to go. He will even probably dodge questions about July, and nobody thinks they're going to do anything in July. And the question about September is, how do these inflation reports come in between now and the September Fed meeting? And so that's why the market's going to pay more attention to CPI than to Powell. But it'll be interesting to hear what he has to say about how the Fed is thinking about the progress that they have made so far.
You know, those commentators who say the Fed should already be on the move, I'm thinking Neil Dutta, Mohammed Al-Arian and so on, they are, even
I think it was
more
get on with it already, is I think what he said.
That's exactly what he said.
Right?
Well, the fear is that they end up behind the curve. And those are the people who would be looking at the SOM rule, which, just to explain it a little bit, it's the 3-month moving average of the unemployment rate minus the lowest 3-month moving average number of the past 12 months. Sounds complicated, but it's not that bad. You could do it on an Excel spreadsheet.
Hopefully Claudia doesn't give us a quiz on it.
If you get 0.5% rise, then in theory, from the low, in theory, you're in recession. However, you have to look at why the unemployment rate is rising. Normally, in a recession, it's because jobs are going away. In this case, jobs aren't going away, but more people are going into the labor market, and so there's a greater supply, and we have a higher unemployment rate. And not to predict what Claudia is going to say, but I think she has noted that this is a question about the accuracy of the SOM rule in this particular situation.
Yeah, she's absolutely saying that, maybe this is something that we should be watching closely, but that there could also be, of course, exceptions to the rule that has proved, pretty golden standard.
If we hit the SOM rule, it doesn't matter whether Claudia Somm thinks it's accurate or not. The markets are going to freak out anyway, because that's what they do.
Yes, exactly, particularly the last 18 months or so. Michael, thank you so much. Michael McKee there, our senior correspondent there on all things economy and jobs related. Let's move to somebody else now who knows a lot about this area. Jane Oates, a senior policy advisor at WorkingNation. That's a non-profit media organisation focused on employment. She's also, by the way, a former US Department of Labour official, I believe, in the Obama administration. So Jane, what was the takeaway for you today on the state of the labour market in the United States right now and how much it might be weakening?
Well, I think, just as Michael said, I was thrilled to see more people entering the labor force. That labor market participation rate has been just, stubbornly stuck. So it's great to see it come up a little bit. I was disappointed to see the huge drop again in temporary help because, that temporary area is a way that a lot of people get back into the workforce or get their first job.
Why do you think that's happening, Jane?
Well, I think the easy answer, Tim, would be to say it's all the layoffs in tech. A lot of the temporary workforce was specifically in tech. You had places that trained people that had an associate's or a bachelor's degree in a specific thing, like they did data analytics or they did some kind of data visualization software. And since all the layoffs are happening, there's not that need for new talent in the temp space. But I'm watching it because, it's down 500,000 plus in the last 3 years. That's a lot of a decline.
For sure it is. Jane, what more could the administration be doing right now? It comes out every month and says, look, we've been doing a fantastic job. This doesn't happen. It happens proactively and our policies have created all these jobs. Is there more that could be done?
Well, I think the only evidence that we see this month that things are starting to work is the uptick in construction. Construction and manufacturing have been relatively flat. So that increase this month in construction, the 28,000, which is over what the average has been, is a good sign that the infrastructure money is really starting to kick in at the local level. So I'll take that as a ray of hope and hope that it's a trend that really continues.
Jane, President Biden weighing in this morning after those numbers came out, he said, quote, "We have more work to do. Wages are growing faster than prices and more Americans are joining the workforce. Too many Americans are still feeling squeezed by the cost of living." So that's certainly his concern, and obviously it's very political. The first question of the debate was all about the economy last Thursday night. What more from your view, and I know you focus on, at WorkingNation, you focus on the future of work, but what more on your view can sort of match worker salaries with price increases?
Hardest thing, Tim, in that space is things like chicken and eggs and gas can start to come down, but rents and housing prices are still stubborn. So people are seeing that, especially young workers who are trying to buy their first house or move out of their parents' home and get their first apartment. So I think it's going to take a lot of time. And I do think there's got to be continued work in Congress, to make sure that there are policies in place to make sure that first-time home buyers get a good chance at at getting that first home.
Jane, the payoff between inflation and wage gains, right? It's a finely balanced one for the worker. What is the sweet spot where workers are getting enough to cover inflation, but they're not stoking inflation by getting those rises?
Yeah, I think the best thing is when we see people working, more full-time people. I think one of the great things is a lot of workers, that number came down in what we call discouraged workers, came down by almost 500,000. So I think people are moving from temporary employment, from part-time employment into full-time jobs. That's great because it takes the pressure off on things like healthcare. People get benefits. People have paid leave. They can have sick days if their kid gets sick or if they get sick. So I think that's something that's going to remove some of the pressure. I think the other thing is more stores have to join the band that's joining, saying like the Walmarts and Targets of the world, saying they're going to make an effort to lower prices. I think the price increases that we saw during COVID in goods are still stubbornly high. And I wonder if there's not ways to bring those prices down.
Jane, I know that one area of concern for you is the idea that the youngest people who are eligible to work aren't necessarily working right now. And when you think about those jobs that teenagers get, people 16 to 19 years old, talk about why that's a focus for you. We don't hear a lot about that.
Tim, you know me too well, right? That's the bottom line. Vonnie, this has been a drumbeat that I've had for years, even when I was in the administration. And WorkingNation does a lot trying to cover these young people as well. If you don't learn those employability skills, think of your first job. You learned how to get there on time. You learned how to do your job. You learned how to work with others, work in a team. If you don't get those skills, schools just can't do it. It's unfair for us to look at high schools, community colleges, four-year institutions, and say they should be doing all these things. They can train us, they can teach us to think, to problem solve, but they can't teach us the things we learn uniquely on the job. So you are right, Tim. High double-digit unemployment in that 16 to 19-year-old age group is going to pay deficits to us in the future. We're going to see those people struggle to really get a foothold in the workforce.
Where are we as well on minority hiring? There had been some, progress made on that, but it feels like it's potentially stalled. What can happen in that regard?
Look, I think that there's still some progress. If you looked at the labor market participation rates, Latinos and Blacks are really increasing every month. But the bottom line is the unemployment rate is still stubbornly higher among people of color than it is of whites. I'm not quite sure what that is. I certainly feel that as construction adds jobs, construction, both in commercial construction and home construction, have always been open to hiring people of color, even hiring oftentimes people who may have a criminal record. So, I think that's all positive news. I think the negative news is until we see the other sector that's really been great on hiring people across the board of color, men and women, manufacturing, until we see some real job growth there, I don't think we're going to, make any real improvement in those numbers.
Jane, we only have about 40 seconds left, but very briefly, we're waiting for President Biden to make remarks at a rally in Wisconsin right now. What do you want to hear from him on the jobs front? What does he need to say to convince voters to go vote for him come November?
So I think he has to say that he's going to concentrate on this, and he has to motivate people to come back to work and motivate employers to continue the hiring trend.
All right, Jane Oates, thank you so much for joining us on this Friday afternoon, this Jobs Friday here in New York. Jane joining us from Arlington, Virginia. That's Jane Oates, Senior Policy Advisor at WorkingNation. It's a nonprofit media organization focused on employment, also a former U.S. Department of Labor official in the Obama administration.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Bond yield certainly down across the curve as we look at the 2-year down 10 basis points, Vonnie, the 30-year down 5 basis points.
Yeah, it was a huge day for yields. The whole curve shifted. And again, as you say, the 2s, 10s part of the curve, perhaps more so than the long end. Let's bring in somebody, though, who could tell us a lot more about that. And that is in studio, Michael Mackenzie of Bloomberg News. And of course, with us remotely is Bloomberg Intelligence rates strategist Ira Jersey. Michael, let me come to you first. How big of a move is this in yields, considering we've seen several round trips for yields this year?
I think it's still pretty much a range-bound market. That said, the softening we are seeing in labour is sort of got the market now more comfortable pricing in pretty much close to 50 basis points or 2 rate cuts this year. September remains live, and the sort of what you're seeing here.
You know, Michael, we're going to have to, they're still working on getting your mic up. Excuse me. I'm going to jump in.
Genius.
Was genius what we're saying. I'm going to get you to, you'll get to ask the question again, Vonnie, but I do want to bring in Ira Jersey, who's with us from New Jersey. He's Bloomberg Intelligence senior rates strategist. Same question over to you that Vonnie asked. Since we have seen such a round trip when it comes to rates, how do you look at today's news and the drop in rates that we're seeing across the curve, Ira?
Yeah, I think the Fed thinks that or the market thinks, I should say, that the Fed thinks that they need an excuse in order to cut interest rates. And when you have, a slowing job market, then certainly that is one of the key indicators. So not a huge surprise that we've had a bit of a rally on the somewhat softer data, particularly that little tick up in the unemployment rate, although it really was pretty incremental overall. The fact that the front end is rallying so much is a signal, not so much that the Fed's necessarily going to start cutting early, but that the Federal Reserve might cut more than the market was thinking before. So when you look at the, all throughout the curve and shorter term interest rates, like SOFR futures, for example, which are now the new short term interest rate instrument to look at and that everyone uses to hedge. You look at 1 year and 18 months out from today, and those have rallied the most. And I think that that's a signal that, look, no one really cares in the macro if they cut in September or cut in November or cut in December. It's a matter of where they get to at the end. And we're starting to think that, hey, maybe instead of only cutting the 3.5%, maybe they're only going to cut the 3%. And that's starting to get priced in the market now.
Well, that is fascinating. Well, Michael Mackenzie, let's bring you back in here because it'd be nice if you reacted to what Ira said and also, explain to us a little bit about why we are seeing the jobs report weakening ever so slightly, but such a big move in the bond market, because it may not be a big move to us this year, but in general an 8 basis point move it's a pretty big move.
It is a big move, but you have to remember we had July 4th yesterday. A lot of people aren't in the market today. I think also you've got 2 big events to come next week. You've got Powell's semi-annual testimony to Congress, and then you'll have the CPI. And I think the CPI data is what the market is probably waiting to get confirmation that they can push beyond more than just pricing into cuts for this year. I think the other interesting thing here is the market still isn't pricing in 100 basis points of cuts that the Fed itself expects for next year. And that'll be the next leg of this trade. If you do get signs that inflation is cooling, the labor market is continuing to cool down here, then you're going to see the market start to get more comfortable price meeting what the Fed is expecting for next year. And that'll help the front end. And it is very much a market that I think is the front end is going to lead the charge here. The uncertainty, of course, is just how much can the back end rally, given the election is going to increasingly come into focus. And as someone explained to me today, you're going to be reminded all the time about the spending is not going to slow down, the deficits are going to continue to rise, and you're going to see, I think, a restoration of a positive term premium in the back end of the curve.
Hey, Michael, one of the reasons we love talking to you is exactly that. You do talk to people every day in the bond market, people who are buying and selling, people who are participating. But on a day like today, the day after 4th of July, when you said not many people are actually at the office today, who is? Who are you talking to? What are they saying?
Strategists and investors, and there's still people who are monitoring the market. But I think in terms of being positioned, taking on new positions, putting new positions to work here, you're really going to have to see how the inflation call pans out from here. So I think next week is probably going to be more important. Also, it'll be interesting to hear how Powell, is he a little bit more dovish, or does he kind of stick very tight and stay very, very focused here and say, look, we want the optionality. We're still looking to do at least one cut this year. And I think that's what the market needs to take on board too. But I'd say today's movement can be exaggerated given the thin liquidity.
For sure. Ira, what will Fed Chair Powell want to convey to Congress next week?
Yeah, I doubt that he's going to shift significantly from the June meeting. I mean, the preponderance of the data has actually been Fed friendly, right? Where things are slowing down, but they're not slowing down quickly. And, he can point to a lot of the data suggesting that, look, the job market is getting more into balance. I think he'll use that again. He'll more or less stick to the minutes. The monetary policy report, and remember, it's a 70-odd page report. I haven't been able to read the whole thing yet. But the monetary policy report just came out a couple hours ago. And, that didn't say anything, at least the executive summary didn't say anything much different than what they said in the minutes that came out on Wednesday. So I think he'll stick to that script. I think he has to, because remember, he's talking for the whole committee, not necessarily his own beliefs. Now, if he's asked, what do you personally think? I think that could be a little bit more interesting. Also, remember, he starts with the Senate this time. So the Q&A afterwards might be a little bit more technocratic, a little bit more technical, as opposed to the political grandstanding that often happens in the House of Representatives, which will be the following day.
I mean, Ira, you still have all weekend where you can sit back and enjoy some time outside reading that report. So Monday we'll expect a full summary when we speak to you. But before then, I want to get your thoughts on the way that rate investors have thought about cuts this year after today's data. It was a mixed report. We spent a good portion of time at the top of our show, Ira, going over it. How did you see any sort of reset in how traders are thinking about cuts from the Fed?
A slight reset for this year, making higher probabilities of September. Like September's now, I would say, a live meeting. I still suggest that the data might not be quite weak enough that the Fed's comfortable starting to cut in September. Keep in mind that the words to listen for with Powell next week after these data that we received is, do we have risks of cutting early and risks of cutting too late? And he was asked specifically earlier this week about whether or not September was when they were going to start cutting rates, and he said, "Look, every meeting is live. We're going to let the data lead us." So it really does depend on the next 2 months of data prints as to whether or not September is when they first cut. But quite frankly, unless you trade those instruments, it doesn't really matter. I'm looking more at like the late 2025 instruments, because that's really what tends to move the 2-year note, the 5-year note, and the whole rest of the Treasury yield curve.
Yeah, Michael, I want to come to you on that because it's fascinating. It used to be that we'd watch the 5-year forward a lot, and now, as Ira was saying, it's really 1 year and 18-month forwards. Where else should we be looking for indications?
Well, I think that's where you start. I think there is a debate in the market whether or not the Fed may have to actually cut a bit more aggressively than what is currently the consensus, because if things really start to slow down, as someone explained to me today, it's better that you actually be a little faster with the cuts to start and then step back and wait to see how things pan out. So, then over the next 18 months is where you're going to see, I think, the majority of cuts, because I think longer term, you can make a pretty good argument that, inflation will probably be a little stickier. You've got supply chain issues still evolving. We still haven't really got beyond the COVID experience in terms of how that's changed the economy. And I think you can argue that R-star is probably, the long-term neutral rate is probably higher in this environment, particularly with the spending. There's still stimulus coming through the economy from the spending we've seen under the Biden administration as well.
Michael, in terms of next catalyst that you're watching, next week is a big week. We, of course, hear from Jay Powell on Capitol Hill. We alluded to that moments ago. But also we get inflation data coming on Thursday. What's the bigger news for you?
I think it's the inflation numbers.
Yeah, Mike McKee said that also.
Okay. I think that's where the market becomes. What's really interesting looking at the bond market at the moment is that it has been unwilling to go beyond pricing in more than 2 cuts. And that has what we began this year with 6 cuts priced. The market has been actually very, very, I think, disciplined. It's been burnt pretty hard in the past by all these trying to anticipate these Fed pivots. They really want to see the inflation numbers. And if inflation numbers are cooperating and moving in that right direction, that will give the Fed the ability to actually go in September. So that's why, it's live, but it's not fully priced.
Ira, we're going to be speaking to.
I think Mike makes a good point there, because the Fed needs cover at some level, right? Because some indicators are still suggesting that the economy is running pretty quickly, and if they start to cut interest rates, people are worried. And a lot of investors that I talk to are worried about a reacceleration of inflation if the Fed does cut too early. So you need to see those inflation numbers come down, and that is going to continue to be the key, because that's going to give them the cover to be able to cut interest rates, and especially if they cut as early as September.
Yeah, I mean, you probably know what I was going to ask is about the SAM rule. We're going to be speaking with Claudia later, and she allows for, exceptions to the rule and so on. But, I mean, does today's data make it any more likely that we're closer to a recession?
Maybe a little bit, but typically, and look, I've gone back in history and looked at like percent changes in employment in both the household survey as well as the establishment survey, and all of those are running at levels that we had like in the mid 2000s or in the 1990s. Call it like when you're growing the employment by about 1%, 1.5% per month on an annualized basis. That's typical, and that's right where we are now. The question is will it decelerate further? And that's where things like Fed forecasts and everyone's forecasts will matter as to whether or not you think the economy is cooling and having a soft landing, or whether or not we are going to go into recession. It's not unusual, Vonnie, keep in mind, for the Federal Reserve to start cutting interest rates when payrolls are still positive but declining. But at the same time, 200,000 jobs being created a month, if you believe that number, which, I know Anna Wong and some folks at Bloomberg Economics question the validity of it. But if that is correct, then the economy's fine, right? At least the job market and that part of the Fed's mandate is not bad with a 4% unemployment rate.
Hey, 40 seconds left, Michael Mackenzie. I want to end because we're focused on politics. We're going to hear from President Biden in just a few minutes. What are you watching when it comes to rates, if there were to be some big surprise come in the coming days?
I think watch the curve. Last week we got a pretty nasty bear steepener. Today we're getting a bullish steepener, which is the preferred way the market likes to see the curve steepen. But a bearish steepener would be problematic.
All right, both of you, thank you so much for keeping us on the straight and narrow, or on the curve, I should say. We talk about the jobs data today. That is Bloomberg Intelligence Rates strategist Ira Jersey remotely with us, and in studio, Bloomberg News' Michael Mackenzie.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Tina Fordham is geopolitical strategist and founder of Fordham Global Foresight. Tina, first, before we get to the UK or anything like that, can I ask you your impression of what's going on in the United States right now? It sort of took a left turn. We were all highly focused on everything court related to Donald Trump, and suddenly now we're focused on whether President Biden could even run for another term.
Well, for me, it was entirely consistent with what we were thinking about this election. There are too many variables, too many new factors and fluidity in this race for it to follow a typical US elections playbook. And that's exactly how it's playing out. Things are starting to come loose.
Yeah, I guess the question is how much more loose do they become before things start to, I guess, become tighter? And that's certainly a question a lot of Democrats are probably asking right now, Tina.
Absolutely. But what we're observing is how campaigns and leaders, no matter how dedicated they are, can't control everything about the process. That's what we're witnessing now. I mean, I've encountered a fair amount of hostility for, my observations straight after the debate, saying I think that performance was a game changer, and age is not reversible. Of course, Biden will do better in other contexts, other environments. He is a very competent politician with a great deal of experience and has presided over an important economic recovery as far as I'm concerned. But Americans are right to ask if he can serve until 2029. And it isn't a matter for his comms team to simply provide reassurance.
Yeah, exactly, Tina. And just by the end of today, we'll have a lot of commentary from Joe Biden. As I say, we're waiting for his comments from Madison, Wisconsin. But if it were to happen that Joe Biden steps aside and somebody else comes in, be it Kamala Harris or Gavin Newsom or whoever it may be, what would that do for Donald Trump's chances of winning? And I mean, we have head-to-head polling right now, but we are still very far away from Election Day when it comes to US elections.
Well, we're very far, and yet I think I'd make the case that if a change is going to take place on the Democratic ticket, it needs to happen in the next few weeks. The NATO Summit in 2 weeks' time is a major signpost. Actually, it's next week, isn't it? Mm-hmm. The U.S. will be hosting in Washington world leaders, including the new U.K. Prime Minister, Sir Keir Starmer, and possibly a new French Prime Minister, almost certainly a new French Prime Minister. So a lot of change in the global environment. That would also be an opportune time for the U.S. Head of state to speak to allies. But that may be a faster timetable than the White House and the Biden team are prepared to look at.
We do have an article out on the Bloomberg about allies being concerned overseas about the current president's ability to win election come November. I'm wondering what kind of pressure, if any, that could put on Biden to step aside.
Well, there'll be reluctance from U.S. allies to put on any pressure, that's for sure. But part of the reason, if not the main reason, why U.S. allies and indeed my CEO and investor clients here in Europe are so concerned about Biden's state is because they are so worried about a return of Trump to the White House. And that is a really consistent view across the political spectrum, just because of the feared implications of a Trump 2.0 on the global trade environment, tariffs, and security. Remember that here in Europe, security with the war in Ukraine, as well as the Middle East, number one consideration, and U.S. consistency on that is very much in focus.
Tina, you probably didn't think you were coming on to talk U.S. Given the British election that we've just had, we suddenly have a new regime. Does anything change in Britain radically pretty soon? And I'm talking about anything from relationship with Europe to fiscal policy to any kind of social policy.
Well, I think British voters certainly hope for a change. They gave the Conservative Party, which, remember, the Conservatives have been in power for 14 years, a real drubbing last night. It was something to behold. And one of the things that will be surprising for your U.S. viewers is that Rishi Sunak is already out of Downing Street. The removal van has been, Keir Starmer has met with King Charles, and it's all change. Same with the Chancellor of the Exchequer. So there's no grace period, there's no lame duck period, there's not even a transition period. The new team will be in their seats in the coming days. A Labour Party government with a majority represents a significant change, particularly a departure with Brexit. And remember, that's probably the signature achievement as such for the outgoing Conservative Party. But the cupboard is also bare for Sir Keir Starmer, and he's really made the biggest promises about returning the UK to growth. Growth here is languishing, and restoring public services. So business is actually backing Labour for the first time that I can remember.
That's a part of his speech. It was this morning for me, but this afternoon for you, that really struck me earlier today, was the idea that government is there to help and that the services are there for the people. They are you don't necessarily hear that here in the United States. A lot of people think government really gets in the way, and that's certainly the philosophy of a lot of folks here in the U.S. Can you explain how things like the NHS have been under pressure and how it's such a loved organization and how that was so crucial to Labour's victory here?
Yeah. Crumbling public services appear in the top 3 concerns for British voters. It will surprise Americans on the right to understand that the NHS is a much-loved national institution. People look with horror at the United States and the idea of medical bankruptcies. doesn't exist in this country. And so finding a way for the NHS to be more efficient in light of an aging population and everything else is a major task, to be sure. And one that, I think any incoming government would have to be looking at tax increases. But the American viewers need to resist the temptation to kind of put everything in U.S. terms. Labour Party has got socialist in its name. It has taken a lot of steps to cultivate ties in the City of London, our equivalent of Wall Street. And frankly, the Conservative Party has not been the party of business for some time. With Brexit, they kind of threw financial services under the bus. Labour will have no honeymoon, and their landslide victory is probably more of a kicking to the outgoing Conservatives. Someone called it a loveless landslide, and I think that that's probably fair. But also, it has been a completely peaceful, civilized, drama-free transition, and I think that should be inspiring for us Americans.
Oh, yes, a drama-free transition. Gosh, when did we last have one of those? I'm really not quite sure. Tina, thank you so much. Can't wait to keep in touch with you throughout the next few months. That's Tina Fordham, Geopolitical Strategist and founder of Fordham Global Foresight.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.